So you're starting the search for your first home, or maybe you haven't owned a home in a little while or making the move. Well, in this video, I'm gonna take you through the top 7 things that you need to know before buying your first home, or home that you haven't had in a while. And stick around to the very end, because I have some information for you, especially now that the market and the real estate landscape has changed. So if you're moving to the Charlotte area and you want to know more about it, well, you've come to the right channel. Be sure to like and subscribe. Every week I am dropping videos, everything about Charlotte, North Carolina and South Carolina, the good, the bad, the in, the out, everything you didn't know you needed to know. So if you want to be in the know, go ahead and hit that subscribe button. I'd love to have you as a member of the family. My name's Kayla Lindsay, and I get calls, texts, emails, Zoom invites from people just like you looking to move to Charlotte, North Carolina and the surrounding areas, including South Carolina. So if that's you, go ahead and drop into the description below. All of my contact information is there. Whether you're making the move 9 days or 90 days from now across the world, across the country, or just across town, buying or selling a home, I want to hear from you. Give me a call, a text, or an email, or go ahead and set up a Zoom invite. I'm here to make your move exactly what you want it to be. This video today. What do you need to know when buying a home? Well, I get all of these questions quite a bit and I cover it with all of my clients, so I figured, well, I might as well go ahead and make a video because I'm sure there's others out there. What do you truly need to know before buying a home? Well, we're going to count back the top 7 things that you need to know, starting at the top with number 7. This home is probably not your forever home. Yeah, I know that sounds crazy, and everybody thinks, oh, I'm gonna get the perfect house, it's gonna be the home I'm gonna stay in for the rest of my life. On average, people sell their homes every 5 to 7 years. Some of my clients are selling it the following year for various reasons. Other ones are staying there for 10 years or more. But on average, we're seeing 5 to 7 years. Now, in this time, of course, a lot can change. But what I am gonna tell you is if it's your first home, don't worry about being your dream home, all right? You may find your dream home, I'm not saying you won't, but don't be so caught up with that. So I recommend to all of my clients, make a list, your must-haves and your nice-to-haves. And what's gonna happen is we're gonna focus on that list of must-haves and we're gonna focus on the things that can't change. For example, if you're looking at a house and you want an updated kitchen, you want a 2-story home with a back porch, and you wanna sit on a half an acre. Some of those things can be done later, while other things aren't changeable. You can't make the lot any bigger. It's going to be fairly expensive to add a second story, or if it is 2 stories and you're looking for a ranch, you can't cut that second story off. But what you can do is renovate the kitchen, and you can add on a back porch. So there are things that can be adjusted once you move into the home. So let's focus on the must-haves. This way you find exactly what you need, and then you can turn that house into a home. There's a lot of renovations that people do when they move into their homes, and some of them are easier than others. I always call it the how much TLC do you really want? Some people are okay with getting kitchens and bathrooms, while others are more along the lines of changing out the carpet and adding a little paint to the walls. Regardless of where you are in this, understanding and knowing what you truly need is going to be definitely ideal, especially as you start the hunt. Not every home is going to fit the bill, but if you can find a home that is almost perfect, let's see what it can take to make it perfection for what you need over the next few years. Now, one other thing I'm going to note about this. Many of my clients who are looking for their first home start to talk about schools, but they don't have kiddos. Here's what I'm going to recommend. Well, first off, if you don't have kids yet and you're planning on them in the future, more than likely you will move before that kiddo hits kindergarten. The second reason is sometimes school districts and boundaries change. School ratings also change. So with that being said, unless you're going to be in an area that's literally surrounded by top schools, those districts and schools could change not only where your child is going to end up going, but actually the rating of that school could change in the next 5 to 7 years before your child gets there. So plan for the now and plan for the next 5 years. Things can change, so keep that in mind. Number 6 on the list, don't be house poor. What do I mean by this? Just because the lender gave you a pre-approval number doesn't mean that that is the price of the house that you need to be buying. What do I mean by this? Well, let me tell you a quick short story. When me and my husband were first approved for our loan for our very first house, I remember us looking at the lending document, looking at the amount, and then looking down at what? The mortgage payment. See, my husband and I were looking ahead. We knew just because there was a number on a piece of paper, it didn't mean we wanted to max out that number. So, for example, if you get with a lender and they tell you you can buy a $500,000 home, you want to make sure you're focusing on what the actual mortgage payment is, mortgage, taxes, and insurance. That monthly nut is what your focus should be on, because if that's uncomfortable for you and your budget, you don't want to get to that number. Instead, we want to work backwards and make that smaller. Now, of course, a pre-approval letter is going to show you what you can buy, what you can be approved for, but if it's going to make your lifestyle a little bit tighter, a little bit more uncomfortable, maybe it's not worth it and we need to look at a different price point. Well, that's exactly what happened with me and my husband. The lender gave us that number on a piece of paper and we looked at it and we said, okay, well, we can do this. And it actually looks a little bit high, to be perfectly honest. It's kind of tight for our budget. Well, my husband called the lender to ask about it. And before even saying anything, she said, oh, what? Do you need more? We can go ahead and increase that another $50,000. And he said, no, absolutely not. This is a little tight for us as it is, but thanks for offering. What that lesson taught me, especially once I got into real estate, is that being house poor isn't worth it. We know that inflation is on the rise. We know the cost of goods is on the rise. We need to make sure that you can not only afford a house, but you can afford those groceries and maybe going out to dinner every now and then. These are not things that the lender is going to take into account when they're running your pre-approval. So be sure to go ahead and check your own finances, your own budget, and determine whether that price makes sense for you. And if it doesn't, then we work backwards. We know what your maximum is. We work backwards to figure out what mortgage payment's going to make sense, and therefore what the purchase price needs to be for you to be in a good position. Because nobody wants to be in a bad position when it comes to finances. Number 5 on the list is a 30-year mortgage doesn't mean you need to keep the house for 30 years. I remember a client of mine a while back had said to me, Kayla, it's a 30-year mortgage. I don't want this house for 30 years. That's a lot of payments. I had to talk to them a little bit about how it really works. The reason that they have payments of either a 15-year mortgage or a 30-year mortgage, those are the two most popular because it spaces those payments out over that period of time, making it, well, more affordable. Now, the difference between a 15-year mortgage and a 30-year, it's not necessarily that you have to own the house for a longer or shorter period of time. In fact, it's actually going to change your payments a little bit, where a 15-year is going to be a little bit more and a 30-year is going to be a little bit less. But the other really big difference why people go for a 15-year over a 30 is that you're putting more money to the principal or the actual cost of the house than to interest. With a 30-year mortgage, that first 15 years, you're paying more to the interest than you are to the principal. In fact, the first few years of the mortgage, you're actually paying 2/3 of that payment just to interest. So that's why some people will go with a 15. Now, all of that being said, just because you have one of those loans doesn't mean that you are bound to that interest rate or the loan for that period of time. It's just showing you how long you would have to pay it off if you were to. So what do I mean by this? Well, you can always go ahead and refi the terms. Meaning if, let's say, rates drop, you can go ahead and refinance that loan, actually starting a new 30-year mortgage at a lower interest rate. You can do the same for a 15-year mortgage as well. So how does buying a home sooner than later actually affect you? Well, prices in the Charlotte area keep going up. Charlotte and the surrounding area, including South Carolina, are increasing by 6 to 10% every single year, which means the sooner you buy a property, the more your equity is going to grow over time. The second reason is because interest rates fluctuate. See, I have some clients that have been waiting for interest rates to come down. That's right, over the last 2 years, they've been saying we're gonna wait till rates drop. And here's the challenge that's happened. Over those last 2 years, the prices of the properties have gone up and up and up. And while their approval stayed at the exact same amount, now they've been priced out of some of the homes that they could have purchased 2 years ago. Now, I understand, of course, interest rates play a huge role in your monthly mortgage payment, and we never know when rates are going to drop. But if you have the financial ability to do so, buy in when you can buy in. What's going to end up happening is, as interest rates fluctuate, you can refinance the property into a lower rate. And no, it's not a huge process. It's actually very simple. We've done it multiple times on our home. You're going to refinance the property into a lower rate. Well, guess what? Now you have the value, or should I say the price that you paid was from 2 years ago. But what your interest rate is something of today. And in fact, interest rates did just drop here recently. So you can marry the two together and you can refi anytime you want. The third part to this is that every month you're gonna make a payment to someone, somewhere, in order to live. Well, wouldn't you like to pay it to yourself? Meaning putting it into a property that you own, that when you sell it, you'll get the equity back out? That's what owning a home will do. And in fact, you actually get tax incentives and breaks by owning a home. It is a phenomenal investment. So 30 years doesn't mean 30 years, and jumping into a home sooner than later is only going to be advantageous for you and for your future wealth building. Number 4, talk to a lender early on in the process. Now, I have a lot of people that are like, when I find the perfect home, I'll go ahead and talk to a lender. But until then, this is about what I want to spend. I know exactly where we're at. I'm going to tell you right now, that's not the best plan. And here's why. Quick short story. I had a client a couple of years back when things were obviously popping off everywhere when it came with real estate. And what ended up happening was he had a great job. He was a dentist. He had a good position. He knew financially he was fine. And he insisted, I'm not getting a pre-approval. I'm not talking to a lender. When I find the house that I want, I'll die then. And I finally gave up asking and I said, okay, that's fine. Well, turns out he found the perfect house and he took a look at it. He walked through it at an open house. So they had just listed it that day. And he called me, he said, I need this house. I said, well, then we need to rush a pre-approval. So I get him with my lender, my preferred lender. They are rock stars and they got on the phone, they get things moving forward. And then it was a hard, screeching stop. Why? It wasn't because of employment. It wasn't because of his credit score. It wasn't because of any of those things. It was because of a cable bill that went to collections. And you're probably wondering, what? Yeah, that's what we all said. What happened was when he was still in college, he and his roommate had a cable box, as we all did in college, and apparently neither one of them dropped it back off at the cable office. So instead of the cable company calling them and notifying them, they sent it to collections. And guess whose name it was in? His. Well, because that $30 cable box went to collections, he couldn't get a pre-approval. Now, mind you, you're all probably sitting there going, well, that's easy to get taken care of. It is, and you're very right. The problem was the timeline. Because he waited to the last minute to get that pre-approval, by the time we were able to wait for the offices to open up on a Monday morning, get it cleared off, get it off of his credit, guess what? The house was gone. So if you're starting this process, it is so imperative to get a pre-approval. Now, the reason we want to get a pre-approval, not only to avoid that situation and to make sure there's no skeletons in your closets that you didn't know about, trust me, it's happened to everybody, right? But with that, you're also going to understand the cost associated. What do you need for a down payment? What are your assumed closing costs going to be? They give you an estimate. What is your interest rate? And what can you actually afford? The lender's going to be able to talk to you about all of these things once you submit all your information. So you're walking into this as an educated consumer, as someone who already feels confident making an offer on the house that they love because they know exactly what it's going to cost. Now, along with this, there are different lenders out there, and I understand that. Not knocking anyone, but I will tell you, trusting a preferred lender, someone who does this day in and day out, but having a trusted lender, someone who does this day in and day out, that doesn't work banking hours, and is actually available when you're wanting to make offers, is imperative. Here's one of the biggest differences: a pre-approval versus a pre-qualification. Now, a pre-qualification is something that you're going to get very quickly and easily online. You can get it from any kind of online lender, which I do not recommend working with, by the way. And what it consists of is you putting in, them understanding what your credit score is, and you verbally or written tell them how much you earn in a year. Now, while this may get you an understanding of what you might be able to afford based upon what your income is, as well as knowing your credit score, because that'll tell you close to maybe what your interest rate might be, there's a lot of things left undiscovered, and it doesn't mean you can actually get a loan. See, in fact, if you went in and purchased a property with a pre-qualification letter, the lender hasn't actually told you they can give you that money. Instead, in the fine print underneath it, it's going to say, once we actually look at your finances, this is about what we could probably give you. Now, I don't know about you guys, but I like certainty in my life. And when I'm putting money down that's non-refundable on a house, I want to make sure that I can actually get the loan. So I have seen it in the past, not any of my clients, but I have seen it in the past where buyers have fallen out on a property, leaving their money on the table, non-refundable, because the lender finally looked at their finances once they were under contract. Now, here's the thing. There are a lot of lenders, and usually the bigger banks and credit unions and some of these online lenders, that's what they're gonna do. You know why? they don't want to put you through underwriting because it's a cost to them. Well, I don't work with lenders like that. I want to make sure that all of my clients have exactly what they need. What do they need? A pre-approval. Let me explain what goes into a pre-approval. With a pre-approval, you are still going to go ahead and give them your Social Security so they can go ahead and pull your credit. You're going to tell them how much you earn, but they go much deeper than that. They're going to take a look at your actual debts. So they want to know if you've got other mortgages, car payments, if there's any credit cards that you're making payments on. They want to understand your W-2s. They're going to look at your tax returns. They're going to look at everything. And while it's a total pain in the butt, trust me, anyone who's not analytical hates this process, right? But it is so essential to rip that Band-Aid off early. The reason being is when they give you that pre-approval letter, that literally means we already looked at your finances. We know this is what you can afford. When you find the perfect house and go under contract, once we get the appraisal back saying that it is of value, we're going to hand this money over. That's as simple as it is. For every client that I work with, I tell them, I would much rather you go through the headache of getting your pre-approval early than missing out on the perfect home or losing money just because you wanted to save time in the beginning. Most recently, I had a client of mine who was going to go through a quickie lender. I'm just going to call it that. A quickie lender who told her she could get the loan, good to go. Well, I asked her over and over, I said, please get with one of my preferred lenders. And she finally did. And she said, well, that lender, hasn't gotten me the documents yet, hasn't gotten me my pre-approval. Well, I come to find out we were still waiting on documents from her employment. Well, as we go down this path, about 2 weeks later, she finds the perfect home. We go under contract and she insists, I want to use the quickie lender. That's what I'm gonna call him. The quickie lender that I had found, he's already got the letter. It's a pre-qualification. We're good to go. Well, I called my preferred lender and she said, actually, I was about to send paperwork over. She finally got me her pay stubs and it looks like we're going to be able to get her. She got a phenomenal rate. And I said, that's great. You know what? Let me go let her know before we make this final decision. Well, it turns out the quickie lender was requiring her to not only have a cosigner, but the quickie lender was also charging her 1.25% higher than my preferred lender. Once I told her what was going on and that because we did a deep dive on the background and they weren't charging anything extra, that my preferred lender was actually going to save her thousands of dollars, she finally realized there is a difference between lenders and there is a difference in quality and there is a difference between putting a little extra time and effort than going the fast route. So if you are hesitating on getting a pre-approval, they last for 4 months. Just go ahead and get one. Rip off that Band-Aid. It is going to be so worth it financially. And if you need a recommendation on a great lender, regardless of where you are in the country, let me know. I also have some phenomenal lenders for those of you moving out from out of country who don't have credit scores yet. Great lenders, you let me know. Number 3 on the list, understanding loan types. There are a variety of loans out there and understanding what your options are really important. Now, there's a few main types. There's top 4. Your first one is going to be a conventional loan. Conventional loans are what it sounds like. Conventional. It's what most people use. Now, this loan is the predominant loan, especially for larger size purchases. Now, following up behind a conventional loan is going to be an FHA loan. Now, this is a federally backed loan. There are some limitations to it, and the cap on this is $498,000. Now, along with this, they also have a checklist of things that the house needs to meet a criteria. So when we're looking at homes and you might be working with an FHA loan, we want to make sure there's no peeling paint, the house is in good order, it's functional, but there's always something. And when that appraiser comes to look at the property, the appraiser is hired by the lender. They're going to go through that checklist for FHA and see if there's anything outstanding. Here's the kicker. If there is something that the appraiser requires to have done, the seller has to do it or you can't get the loan. Here's one of the challenges to note. In North and South Carolina, a seller's not required to make any repairs at all, even when it comes to lending. So when you are getting into this process, we want to avoid homes that don't already meet the criteria because we can't bank on the fact that the seller's going to do it. Now, hopefully that doesn't scare you. I do a ton of FHA loans and they're phenomenal. One of the biggest reasons FHA is so popular is because you can have a slightly lower interest rate even if your credit score is lower. This is where a lot of people lean into FHA. Now, the downside of FHA is you're going to pay PMI or private mortgage insurance forever, even if you hit that 20% threshold, which I'll talk about in a second. Now, with conventional, you'll drop your PMI once you've put 20% in, either paid in, or the value of the home plus what you've paid creates 20% in equity. Equity is the difference between what you owe and what the market value is. So once you hit 20%, PMI drops off. You usually have to call your lender to make it drop off. And with FHA, it does not. So those are the major differences there. Now, the third most popular loan is VA. This is a veterans program. And shout out to all my vets out there. I love working with our veterans. I wish there was more than just a VA loan that you could have for your service, but at least there's that. Now, a VA loan requires 0% down, which is pretty cool. We're going to talk about this a little bit more in a second. Now, along with the VA loan, only veterans can get this loan. So service members or the spouses of service members can get these. With that, though, they have very similar requirements to FHA when it comes to the condition of the house. So the appraiser, once again, is going to go through and make requests that the seller has to take care of in order for the loan to go through. Now, having all this information is extremely helpful as you start your search, because if you know which loan type is going to be best for you, it's going to help guide you into the next stage. Now, the fourth loan type isn't as readily used. Biggest reason for this: there's limitations to your income, limitations to the amount that can be purchased, limitations to the area, and limitations to the fact that sometimes there's not availability and it takes too long to close. And that is USDA. USDA is a rural loan. So that means if you're further out into the woods or further out into the country, you could potentially get this loan. Once again, over the last few years, it's gotten very difficult to get these loans passed, and most people don't even acknowledge them anymore. So if you've looked it up, I am here with you, and yes, they do exist. They're just a little bit difficult to get approved. Now, with these loan types, they each come with a different down payment. So I'm going to talk to you about this real quick before we hop into number 2. The loan types each have a different down payment. Now, as a first-time home buyer, you could actually be in a first-time home buyers program, which is a conventional loan with 3% down. That's right, you don't actually need 20% down. This is a huge misconception. I've had plenty of clients over the years that said, well, I don't have 20%. You don't need 20%, trust me. So you only need 3% down. Now, for those of you that this is not your first rodeo, well, guess what? You can still get a really low down payment with conventional, and that's 5%, a 5% down payment, still phenomenal. Now, with our FHA loan program, there's only one option, 3.5%. That is the lowest you can go with that, regardless of first time, second time, third time, 3.5%. That's what you're looking at. Now, with any of these loan types, you can put more down if you choose to, but if you don't have to, why do it? Now, as I said, with VA, it's 0% down, but of course you could put money down if you really wanted to, but hey, then what's the point of using VA? And USDA, the reason why it was popular, and still is, if you can get it, is it's also 0% down. Again, a lot of limitations to that one. Now, there's plenty of programs out there for down payment assistance as well, but they're definitely on a case-by-case basis, area by area, and sometimes time frame. There was a time way back when where you could get $15,000 in closing costs paid for. Guess what? That is not as readily available, and as the years go on, there are new programs constantly popping up. So get with a lender that understands what programs are available, because they're going to be able to set you up for success. Number 2, saving for your cash to close. What does cash to close mean? Cash to close is your down payment and your closing costs. Now, we already talked about down payments. This could be a variety, anything from 0% to 5% if it's your second or third home. With that being said, there's another amount people don't think about, and it's your closing costs. So what do closing costs consist of, and what should you be saving for? Now, closing costs vary. They can be anywhere from 2% of the purchase price of the home all the way up to sometimes 5% of the purchase price of the home. A lot of this varies because of what it consists of. So let's go down the list and lay out what these numbers are. One of the first things in this is your attorney fees. Now, attorney fees vary. I have a phenomenal attorney I've worked with for 9 years. They help me with all of my purchases as well, and they are very competitive in their pricing. Now, with that being said, the competition, they also are phenomenal. I have never had an issue. They have found things that I would have never thought of, and helped a lot of my clients when there are things that come up on a property that none of us saw coming. Every single time, they get us to the closing table and everyone is happy. Now, an attorney is important, and it's something that you don't want to skimp on. Kind of like when you go in for surgery. You don't want the cheapest surgeon. You want the one that's going to do it right, but you also don't need Dr. 90210. So with that being said, One of my favorites is Coley Law, and they are phenomenal. So if you're looking to the Charlotte or even South Carolina area, they can take care of you. The next fee you're going to run into for your closing costs is going to be your appraisal fee. Now, appraisal fees vary depending upon the size of the property and the difficulty to which it is to appraise it. Now, with that being said, you don't get to choose your appraiser. In fact, the lender will send out a notice to multiple appraisal companies. From there, an appraiser from one of those companies will claim it, and then they come out and do the appraisal. The reason why they have such a distance from affiliation with the lender is because way back when there were some not so great things going on where people were fixing prices. In order to alleviate that, we tried to go ahead and distance ourselves from one another, from the lender to the appraiser, so that we truly are getting a completely unbiased opinion of price. This is a good thing for you and a good thing for everybody involved. You're also going to have your inspections. Now, most times inspections are going to be paid for prior to the closing table, but some inspectors will permit you to go ahead and pay at closing, which is fine. Especially in a case where maybe a seller is paying for some of your closing costs, it might be one of the best things to do. Now, inspectors are not all created equal, just like not all lenders, not all attorneys, and not all real estate agents. With that being said, finding a trusted inspector is a good thing. Personally, I've worked with for 8 years Home Inspection Carolina. They work in North and South Carolina. They are phenomenal. And they offer everything from infrared to checking of your plumbing and scopes. I mean, they do it all. I absolutely love them, and they also do radon testing. So if you're looking for a great inspector, definitely take a look at them. The other thing you're going to pay for are your escrows. Now, what does that mean? Well, when you close, you're going to have money escrowed put into an escrow account. This means prepaid fees that are going to end up coming up throughout the year, but the lender wants to make sure there's already a little bit of a cushion there. So what does this consist of? This would be prepayment, usually 3 to 4 months of HOA dues if there are HOAs where you're purchasing, a chunk of taxes that are going to be due at the end of the year, and homeowners insurance. These ones are usually pre-collected, at least a few months of it, basically, are going to be pre-collected and put into that escrow account. Now, each month as you pay your mortgage, you're going to keep paying into that escrow account as a part of your monthly payment. The way most people set it up is when this comes due, the lender takes out of that escrow account and pays it on your behalf, so you don't have to think about it. This is what I do, but some of my clients do prefer to have more control over that, and you can override it and save your own escrows if you choose to. The next thing that's going to be a part of your closing costs is your title insurance. And because you're with your lender, you are going to be required to pay this. Now, title insurance is them going back and seeing the changing of hands from person to person throughout the ownership of that property. What they're doing is by insuring that title, if anybody ever comes up and claims ownership of your property, it is insured that is in your name and they don't give up that claim. So it is very important to have that. I can do a whole video on title here at another time, but it's important to hold that, and even if it wasn't required, I'd still highly recommend it. And last but not least, your lender fees. Now, lender fees are going to be the actual lending, so the process of them procuring that loan for you, but you're also going to pay any discount points or fees that you had throughout that. So for example, if you decided you want to buy down your interest rate, you're going to pay for that at closing as a part of your closing costs. So that's actually going to be called discount points. Yes, there's a whole vocabulary for this. So all of those things are going to be a part of your closing costs. So all of that plus your down payment is going to be in combination your cash to close. Now, most of my clients are in that 3% bracket, so they're going to be paying about 3% to 3.5% for their down payment, and then their closing costs are usually 2 to 3% on top of that. So when you're saving, save about 7% of the purchase price of the house. That's going to put you in a good spot in order to make the perfect purchase for the perfect home. Now, you're stuck around to the very end, and number one is extremely important. Might be biased here, but I've seen it go a lot of ways. Hire a trusted real estate agent. Now, when I say a trusted real estate agent, I just don't mean the person that has the smiliest face up on the billboard on the interstate. The person with the most marketing may be the most popular, but they may not be the person for you, nor do they possibly have the skills that you're looking for or need in order to have a transaction where you're going to get the home you're looking for and make it the smoothest possible. When you're looking to purchase a home, you want to make sure not only do you get along with that person, but do they have the knowledge and skills to guide you? Because guess what? Real estate can get bumpy. And if you don't have someone that understands how to handle the bumpy road, navigate it, negotiate it, make sure you get to the end in one piece, it could be a whole hell of a lot more stressful, and you could be putting money on the line. So What does a great real estate agent look like? I'm just kidding. I'm not, but it's not all about looks. You need to hire someone who knows what they're doing. Time in the industry doesn't necessarily mean that they know what they're doing. I've met plenty of agents that have been in the business 20 years, but they maybe do 1 or 2 transactions a year. You want to make sure you're hiring someone who does enough transactions, meaning selling enough homes in a year, that they're constantly in the ebb and flow. You want to make sure they're on the cusp of understanding how much in due diligence or in earnest money do you need to put down to be competitive. What kind of market are we in? How competitive can we be in our offer price? What can we do when it comes to inspections, and what can we request to negotiate there? Negotiation is powerful. I actually just put a client under contract for $50,000 less than the list price. So let me put it this way. It's not the personality, it's not the time in the industry. It's someone who's skilled and is in it every single day. They are going to be the best person to guide you to success when it comes to purchasing your home. Now, real estate agents don't just open doors. I know some people think that, but it's more than that. They're going to have the right contacts for general contractors, inspectors, attorneys, anybody you're looking for, including their trusted lenders. And they've been in the trenches with them, so they know how they actually operate versus just getting a name and a number offline. Now, while they will be able to help you show you properties, as I do, I'm also going to be able to help you negotiate the offer, negotiate repairs, help avoid issues and navigate them before they arise. And if they do, navigate around them and more. We're your team in the trenches. We're the ones going ahead and taking the hit and navigating so you get from point A to point B, which is you with keys in your hands in a home, unscathed. So if you are looking for that, you've definitely come to the right channel. Now, I hope you got value from this video and you're feeling much more confident in buying your first home, or second, or third, or fourth. Now with that, if you do still have questions or you've got comments, maybe experiences you've had, good or bad, drop them in the comments below. I want to hear from you, and I really do answer all of my comments. But more than that, living in Charlotte and the surrounding areas, including South Carolina, go ahead and like and subscribe to my channel. Would love to have you as a part of our community and help you when the time arises. Now, I really do get calls, texts, and emails every day. You know where my contact info is down in the description below. So whether it's 9 days or 90 days from now, if you're moving across the world, across the country, or just across town, I want to make your move exactly what you want it to be. Until next time, I look forward to showing you around town. You want to say hi to the camera? Hi everyone! Quick interlude. This is my little cutie patootie coming in to say hi. Say bye-bye.
Show me your crazy hands.
Crazy hands. Yeah. Yeah. Okay, say bye-bye.
Bye.
Bye. So you're making the move. There's a lot of videos that you can be watching, like this one right here, or maybe even this one. Really either one of these, but honestly, watch both of them because they're going to help you make the move. Go ahead, pick one. They're both really good.